Hey everyone, welcome in to another daily editorial here on the KE Report. I'm chatting with Jesse Felder, founder and editor of the Felder Report. Now, Jesse, we're going to jump around a fair bit here, talking all about the markets, relating everything back to how markets are reacting to the economic data we've been getting, even the recent Fed minutes. But the first, more broad comment that we can make on these markets is that it seems like we are again in this environment where bad news is good news. So that's bad economic data is good news for markets. Markets seem to celebrate any sort of economic downturn, any sort of miss or lower inflation or lower economic data, because they carry that over to the Fed and say, oh, okay, well, the Fed's done with their rate hikes and, well, we can start pricing in rate cuts. Just look at how well the markets have done really just this month. Jesse, take us through what you've seen in terms of, again, this environment of bad economic news, good news for markets.
Well, it's a very interesting time. This time in the cycle happens just the way it is happening right now, almost every time, right? Where you get to the point where the Fed has tightened enough to where financial conditions are tight. You have a real interest rate on, the short-term part of the curve and Fed funds, and it's enough to tighten monetary policy to kind of slow down economic activity. Hopes of a soft landing soar, right? If you look back in the past, when you've seen the number of times the quote unquote soft landing has appeared in news articles and these types of things, it always happens at this point in the cycle. So markets are essentially pricing in, I can't remember who said this, but it was a guest on Bloomberg last week said that we're now in this soft landing nirvana. Right. And when markets are priced for nirvana, that leaves a huge potential for disappointment. And I think that's really what markets are going to start to wrestle with, because if you look at what companies are saying about earnings, right, retail numbers over the last few days, couple of weeks, have been really poor, right? A lot of companies missing and especially guiding in a negative way. And that suggests that consumers are starting to really feel the pinch from rising interest rates and a slowing economy. So I think that markets are priced for soft landing nirvana. What we actually get from the economy going forward might be not nearly as sunny or as optimistic as investors currently anticipate.
So let's quickly recap earnings, especially focused on retailers, because it has been the consumer that has really kept some of that economic data higher. Manufacturing has continued to struggle, but again, retailers, individuals, consumers have held that economy up. But now that we're seeing lower inflation, so earnings or at least revenues could not increase as much because inflation is less. And we're also hearing retailers say we're seeing individuals cut back on some of their spending. What caught your eyes in terms of earnings on the retailer front?
They're generally all talking about soft demand. And I think, there's another thing you can quantify. In addition to soft landing, you can look at how many companies on conference calls referenced weak demand or weakening demand. And I think that hit a record high, according to Bloomberg's numbers. So what I think is happening right now, you see it on the top line, you have sales growth slowing significantly. But companies have been able to boost, juice their earnings because costs have come down. We're seeing inflation come down, right? So they've been able to rein in costs and kind of make up some of the slowdown in the revenues by kind of managing on the cost side. That doesn't last very long, right? Eventually, slowdown in the top line starts to really hurt earnings. And I think that's what companies are warning about now, is that we were able to squeeze out a good quarter or two here, but the cycle's turning and earnings are going to be poor over the next few quarters.
Now, what about your inflation outlook? Because inflation has continued to come down, but it's still a little bit off of that magical 2% number. And I know we've talked in the past where you said the Fed will probably need to adjust their target inflation rate, but it is still coming down. Markets are celebrating that. Even individuals, I'm sure, do want lower inflation. What's your outlook for inflation where it stands currently?
Well, we've had a good, period of disinflation here, a lot of it driven by reopening of supply chains and falling energy prices. I don't know how sustainable both of those dynamics are, right? You can only have one time where the supply chains get really squeezed, creates inflation, and then now they're loosened back up again. And that dynamic is not going to be recreated. Also, on the energy side of things, I think it's difficult to make the case to be bearish on energy right now, just because you look at the fundamentals in like the oil market. They're very bullish, and you look at, OPEC is contemplating even more cuts right now to kind of support the oil price. So those dynamics that kind of drove the disinflation over the last 6 months or so plus are maybe not going to continue. The thing that I think is maybe most important is you look at wage growth is still really elevated, right? I think we're still 4 or 5% on wage growth. And that's a dynamic that if I'm the Fed, I'm watching very closely, because you have that wage dynamic up there still around 5%, along with inflation expectations by consumers are actually ticking higher, right? I think they ticked from 4.4 to 4.5% in the latest Michigan survey that came out today. So if consumers' inflation expectations are rising and they're still getting 5% pay raises on average, I think it's very difficult to have inflation come down in a sustainable way in that environment. I think that's why the Fed in the Fed minutes said they're not even thinking about cutting rates, right? If anything, they might have to hike further in order to kind of break the inflation psychology that looks like it could be building right now.
So, Jesse, why is the market ignoring what the Fed is saying? Because the market is, again, pretty much pricing in no more rate hikes and now rate cuts starting in even the later part of the first half of next year. That's not exactly what the Fed is telling us.
Well, the markets have been well trained by the central bank for a long period of time, right? Even Jay Powell, right, in the famous Powell pivot in, what was it, late 18, early 19, was very clear that when the Fed is going to err on the side of dovishness, the Fed's going to err on the side of boosting the economy. They're going to err on the side of the employment mandate rather than on the side of the inflation mandate. That has been the history of Fed policy for, I don't know, 10, 20 years. I mean, go back to Greenspan. And so I think that investors, I mean, anybody who's been in this business for 10 years or less, 20 years or less, has become accustomed to a Fed that has its back. So to really, I mean, it's a problem the Fed's making, right? They've trained investors to believe that, they're going to be err on the side of support and err on the side of accommodation. Now, I don't think that's at all what Jay Powell wants to communicate today, but he's having a really hard time convincing participants that they have made this shift.
Well, I guess the dot plot is saying that there could be a rate cut next year, but they keep pushing it out. Every meeting, they seem to almost push it out a year. So it is one of those things that it's hard to predict what's going to come at the next couple Fed meetings, let alone ones that happen a year from now. What do you think, though, Jesse? Will there be a rate cut next year?
I think there's actually a really good chance we get rate cuts, maybe multiple cuts. But that is only going to happen if the economy weakens significantly. That forces the Fed to undo some of the tightening that they've done. So, I think interest rates there's so many signs out there that interest rates are really starting to have an impact on consumers and corporations. So it looks to me like they don't really date recessions until well after the fact, but it looks to me like we could be entering recession right now. I mean, that's kind of the message from a lot of these retailers and things, and a lot of leading indicators. Now, if that's the case and it becomes obvious through labor statistics, right? We see the unemployment rate tick up significantly. That's going to be the sort of thing that's lets everybody know, yes, recession has finally arrived. It's not a soft landing anymore. It's looking like it's something more harder than what the soft landing narrative would allow for. And that would be kind of a green light for the Fed to start reversing some of the rate hikes.
What about the consistent unwind of the balance sheet outside of that regional banking crisis that happened earlier this year? The Fed has been unwinding its balance sheet. I think we can even see that in the bond market because, well, one of the biggest players has stepped away. But some of the recent minutes have said that, look, they're going to keep on unwinding that balance sheet even if they're not hiking rates. How significant is this for markets and investors?
I think that it's really important for Jay Powell to communicate that because, they may need to lower interest rates to support the economy and undo some of the rate hikes if we enter recession. But if they can maintain the quantitative tightening at the same time, it kind of sends a signal that the Fed is still worried about inflation, right? That they don't want to do what we did in the 1970s, which is start easing too soon and allow inflation to kind of rekindle and spike again. And so I think that's why Jay Powell has been communicating that is he doesn't want to even open the door to that. If we do, one of my biggest worries is if we go into recession and the $2 trillion deficit blows out to $3 trillion or something, creates an additional spike in Treasury supplies at a time when we already have a supply-demand mismatch, we could go into recession and see long-term interest rates go up rather than down. That would really put the Fed in a bind where Jay Powell, who wants to continue quantitative tightening, may have to actually, step in and add some kind of stability to the Treasury market. The reason he's reluctant to do that is especially with inflation psychology, inflation expectations already rising, it could create a real problem for that trend in inflation psychology.
Hey, that's steepening of the yield curve, right? Going into positive territory. That's usually when the recession, or at least we claim the recession, starts. Let's move into a couple more specific sectors then. You already touched on energy, but I do want to dive into that a little bit more. How do you balance out those fundamentals where OPEC Plus seems to want to keep prices high? The U.S. does want prices to go down, I think, but they don't have much control over that. However, you balance that out with potentially recessions around the world, which could hurt energy prices. How do you balance it all?
Well, there's a potential for demand, obviously, to fall in a recession. The history of recessions, and I think we've talked about this before, is that the oil market, typically already discounts that fall in demand, and that's the falling prices before the onset of recession. Once recession begins, oil prices begin just kind of like the gold price, right? I think we've seen this in gold, where gold declined, significantly into October of last year, kind of anticipating further rate hikes by the Fed, further hawkishness. But it bottomed a year ago and turned higher, already anticipating an end to the Fed rate hike campaign. And that's the strength we've seen in the gold price recently, is that confirmation that the Fed is probably done. And once you see, recession begin, gold price, will take off even further. But I think the oil price has done the same thing. The decline in the oil price is already kind of reflecting worries over falling demand if we go in a recession. Once recession is confirmed, that means the Fed can pivot and start to try and support demand in the economy again. And that's when the oil price typically bottoms, is early on in the recession, and reverses higher. So I think that we've probably already reflected a recessionary scenario for demand in the oil price. A lot of that's been driven by speculators in oil futures and things, and that have offloaded, are massively short oil now in the futures market. That's been part of the price driver, and that's been related to worries over demand. So that's how the market begins to reflect these things. Now, I think once you see recession begin, then the market will start reflecting, what a recovery looks like down the road. As Stan Druckenmiller said, investing isn't about knowing what's going to happen now or 6 months from now. It's what's the world going to look like 18 months from now. And that's what oil price is trying to figure out. That's what the gold price is trying to figure out. So I think if you're selling oil today in anticipation of a recession, you probably already missed that trade.
Interesting. So you think the bottom is largely in for oil, even though it's still around that mid 70s level. It was a pretty quick fall over those last couple months, though. Carry that over to other commodities. More the metals, though. You did touch on gold and how you think gold has a bright future ahead of it. What about other metals? Which metals prices do you think could go up? Which ones could go down in this, again, potentially recessionary environment?
Well, I'm very bullish on gold and silver, and I think we've talked about before. There's a very close correlation between silver and the Japanese yen. It's something about like a 75% positive correlation. And so if you think the U.S. is headed into recession, it's going to cause a pivot in Fed policy. That could be catalyst for a major reversal in dollar yen, and very bullish for the yen, especially at the same time when the Bank of Japan is still talking about tightening policy. So you're seeing a shift in monetary policy between the Fed and the Bank of Japan. And I think we're at a very important inflection point between, in those changing dynamics that could be very bullish for the yen. The yen is so undervalued and so oversold, and so overshorted, right, in things like the carry trade and things, that if you saw and I think we're seeing it, a massive reversal potentially in the yen, can be very, very bullish for the silver price. And so that's something I'm watching pretty closely right now.
What about copper? A lot of eyes still on copper, but some things that I've heard too is that inflation-adjusted price of copper is not attractive to any copper producers. They need sometimes, pretty much all of them need over 380. I've heard many of them need more around $5 copper price to make money and to incentivize any builds. What's your outlook for copper?
Yeah, I mean, to me, that's very, very bullish, right? That they're not going to bring on new supplies until you get higher prices. And this is how you get a commodity supercycle. It becomes very uneconomic for these companies to produce more at certain prices. And I think it's the same thing in the oil market right now, where the only thing that's going to get companies to pump a lot more oil and frack a lot more oil is if you got a really big spike in oil prices. Because we didn't see it, right? When oil went up to whatever, $120, $130 a barrel, you didn't see a supply response. And to me, that's very, very bullish. Kind of the same thing in copper. If companies are holding off on producing because it's not economic for them to do so, that reining in of supplies is only adds to the bull case, where demand, based on this green revolution and all of the the copper demand that's related to all these green technologies, demand is only going higher. And if supplies are going to be constrained, that's just bullish for prices going forward.
Now, just quickly circling back to the gold sector, gold stocks. We've gotten pretty much all the earnings out of the majors. The majors continue to make money, but again, their margins have been compressed from just a couple years ago, and their stock prices on the biggest gold mining companies, they're well off of their highs. What drives gold stocks? What drives interest into gold stocks?
What's going to drive interest in gold stocks is, I think, a rolling over of the Magnificent Seven stocks, right? Everybody is still operating under this old playbook, which worked in the post GFC environment, which is, buy big tech stocks because, that's in a zero growth economy. These are the only things that are growing and they have terrific profits and what have you. I think what people don't necessarily appreciate yet, and this just takes time, is that we've had a paradigm shift in the economy and in markets. We've gone from a disinflationary, low growth environment to probably relatively high nominal growth, but also high inflation environment, a higher inflation environment. And so that flips the playbook on its head. What worked in the post-GFC environment isn't going to work today and in the years to come. What is going to work are real assets. It also helps that real assets relative to financial assets have literally never been cheaper than they are today. But the tailwind to real assets versus financial assets is a higher interest rate environment, higher inflation environment, higher nominal growth environment. And I think that's the new normal for markets. And as investors come to appreciate this, they're going to have to change the way they look at markets. So I think we're in the early days of this. Right now, I look at the gold price, the weekly chart of just gold, and I've been saying this to my subscribers for several weeks now. This thing looks like, look up coiled spring in your technical analysis dictionary, and you're going to see a weekly chart of the gold price. It just looks like it's ready to explode higher. And a breakout to that new highs is really going to drive the miners, and you're going to then start to see some investors come into the space. But it's such an incredibly hated space right now, which is very, very interesting, given the fundamental dynamics for where we are in the monetary cycle, and the technicals are all pointing to, I think, much higher gold prices going forward.
Yeah, that weekly chart after that big bounce or big pop in March has really stayed quite elevated throughout, outside of that quick little drop we saw in September, late September down to 1800, right back to that 2000 level. Jesse, before I get you out of here, though, if this is a good environment for gold, what about Bitcoin? Does Bitcoin do well? Because it has been doing quite well and recently just went to 52-week highs. So, how does Bitcoin factor into this?
I'm not a Bitcoin fan. Personally, the way I look at Bitcoin is it fits more into the framework of a risk asset than a real asset. And that, is probably sacrilegious to say that to the Bitcoin crypto aficionados. But that's how it trades. It trades like more like a meme stock, more like, a risk on asset than a risk off asset. And I think that's really the main difference between Bitcoin and gold is a true safe haven that does well, in times of distress. And I don't see Bitcoin serving the same purpose. So I think if we are headed towards another major risk-off move across markets. I think that could be bearish for Bitcoin, and crypto aficionados could be disappointed by that.
Well, we'll see where it goes, but Bitcoin has done pretty well this year. And, well, if we do get a big, deep recession, too, how's it going to react? Who knows? But we'll follow along. I do find it interesting to cover the crypto space along with everything else. So, Jesse, really appreciate your time today. We got through a lot in this interview, and I hope everyone listening, you all found it very interesting. Jesse, we'll hopefully chat again next month before the new year. I hope you have a great rest of your week and a very happy Thanksgiving.
Thanks, Corey. You too.